Okay, so let's just jump right in. Picture this. The world is practically swimming in money. You've got central banks opening the floodgates, credit is super cheap, and asset prices are just going through the roof. But then you look over at India and you see something, well, completely different. It's like an economy that's decided to march to the beat of its own drum, totally diverging from that global surge. And that brings us to the big question, the real mystery we're going to unpack in this explainer. In a world that's just awash with cash, why on earth is India forging its own path? What's behind this divergence? And maybe more importantly, what could it all mean for one of the planet's fastest growing economies? To really get to the bottom of this, we first have to understand the powerful current that India seems to be swimming against. So let's talk about this global money wave. So, what do we even mean when we say global liquidity? Well, in simple terms, it's just the sheer amount of money sloshing around the world's financial systems. Think super low interest rates, central banks basically printing money, that kind of thing. And all this cash usually fuels a rise in asset prices everywhere stocks, bonds, you name it. It's a powerful tide that's supposed to lift all boats. But see, this is where India's story gets really fascinating. Some economists are even calling it a paradoxical juncture, because despite all that money flowing around the globe, India's own policies, its capital flows, and its domestic markets are all behaving very, very differently. And this slide really puts that contrast front and center. I mean, while a lot of the world is just turning on the taps for cheap credit, India is taking this much more measured, cautious approach. Its market seems to be running on a completely different kind of fuel, almost decoupling itself from that big global wave. And this quote just nails it. While so many other markets really depend on foreign money coming in, it's India's own domestic investors who have become the liquidity engine that's driving everything forward. Honestly, this is a huge and pretty recent shift in the country's whole economic power structure. So, of course, that begs the question, what exactly is powering this engine? What's going on under the hood? Let's break down the key forces behind India's pretty unique path. It really boils down to four main drivers that we're going to walk through. First, you've got this incredible momentum from domestic investors. Second, a very deliberate, very cautious monetary policy. Third, some really fundamental structural differences in the economy itself. And finally, a pretty unique strategy for managing capital and currency. So let's start with the biggest one, the most significant factor here, the incredible rise of the domestic Indian investor. I mean, for anyone who follows India, this right here is the real game changer. This chart tells such a powerful story. For decades, foreign capital was the main event in India. But just look at this. Even as foreign investors have been pulling money out, domestic inflows, mostly through things like systematic investment plans, or SIPs, and mutual funds, have more than filled that gap. This homegrown firepower makes India way less dependent on what the rest of the world is doing. It's a huge sign of a maturing economy. Okay, so let's move on to the second driver and see how this all connects. India's central bank isn't just following the global trend of easy money. No, it's playing a really careful balancing act. They're worried about the economy overheating, and they want to keep a lid on inflation. On top of that, they're already managing a huge surplus of cash within their own banking system, all while trying to make sure the rupee's value doesn't get too strong and hurt their exporters. It's a lot to juggle. And these last two drivers, well, they're deeply intertwined. First, India just has its own unique economic dynamics going on. I mean, think about the massive internal push for building infrastructure, roads, ports, digital networks. That alone creates its own powerful demand for money, totally separate from global trends. And second, the country is very carefully managing how much foreign capital comes in. It's a strategic move, really, to keep their competitive edge and make sure the rupee doesn't get so strong that it prices their exports out of the global market. It's a delicate dance. Okay, so we get it. India's doing its own thing. But here's the crucial question. What does all of this actually mean for you, whether you're an investor or just someone watching the global economy? How do you navigate these two different streams? Here are the key things to keep in mind. This divergence could make India more resilient to global shocks, but it's definitely not immune. Asset prices in India might not move in sync with global markets anymore, which, is both an opportunity and a risk. You also have to watch out for higher policy risk, because India's central bank might just make moves that surprise the rest of the world. And of course, you've got to keep a close eye on the rupee. But, and this is a big but, there's a word of caution here. All this domestic strength could be masking some hidden fragilities.
If a really big global shock does hit, domestic money might not be enough to cushion the entire blow.
So all of this brings us to the final and maybe the most important part of our explainer. Given this unique situation, where could India's path actually lead from here? Let's imagine 3 possible futures. All right, in scenario 1, let's call it the double boom. This is the best of both worlds, global money keeps flowing, and India's powerful domestic engine stays strong. The result? Great growth and a stable economy. Then you have scenario 2, the global shock. Here things get a bit dicier. If global liquidity suddenly dries up, India would definitely feel it. But that domestic cushion might mean it weathers the storm better than a lot of other countries. But then there's scenario 3, the overreach. And this is the danger zone. If the gap between India and the rest of the world grows too large, it could lead to policy mistakes, asset bubbles, and a really sharp, painful correction. Which leaves us with this final, critical question. Is India's great divergence a sign of real, newfound economic strength and resilience, a country finally charting its own course? Or is it a hidden vulnerability, a temporary shield that could just shatter in the face of the next big global storm? The answer to that is going to shape one of the world's most important economies for years and years to come. Okay, so let's just jump right in. Picture this.